Hey miners, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, we have Sue Ennis and Asher Genet back from Hut 8 Corporation. This is one that we've been following closely for quite some time on the channel. They just came out with Q2 numbers. This has been a pivotal year for Hut 8 Corp as they go through a leadership transition and really a business reorganization. We're going to be discussing that in today's video, but before we do, please take a second, smash the like button, you guys. Big help to myself and the channel. Anthony loves it. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comments section below if you're currently holding shares of Hut, what your thoughts were on their results or their Q2 earnings, and your outlook for the back half of the year. Now with that being said, let's get into today's interview. Okay guys, so that's right. We've got the dream team back from Hut 8 Corporation, Asher Genet, CEO. We've got Sue Ennis, my longest running podcasting member in the Bitcoin community, back by popular demand. Sue's head of IR at Hut 8 Corp. There's a lot going on. I said in the intro, Asher, not only have you guys gone through a leadership change this year, but really a business transformation as you start to consolidate these different elements between USBTC, Hut 8 Corp, put it all together, and boy, it's starting to look very good here. So we'll get into all that in today's discussion. But before we do, Sue, Asher, thanks so much for the time here today. We really appreciate it.
Thanks for having us. We're excited to dive in.
Yeah, big time.
Well, let's get right into it. So I know you've been very busy over there, a lot going on. We've been following the news cycles and press releases. Can you give us a quick high-level update of just what's happened since your last visit with us?
I think the fruits of our labors have started to show. When I took over, we focused on really cost optimization and driving growth. And so cost of optimization, even with the halving, I think we showed significant improvements on the business and the underlying fundamentals. So gross margin year over year actually went up by 12 percentage points, and you would expect it to go down after the halving. So I think that was really important from a mining perspective. And that was primarily driven by cost of energy going down. So our blended cost of energy last quarter was 5.3 cents per kilowatt hour. This quarter is 3.2 cents. And even on self-mining alone, we went from 3.7 to 3.2. So we've been driving costs down. And we shared an update that we just closed a new facility for 205 megawatts in addition to the 63 megawatts that we brought online in April. And so additional growth and expansion opportunities for the business.
Phenomenal. We're going to get into that expansion and growth in a second here. Now, Asher, I wanted to bring up a comment you made in one of our first interviews. You said, hey, Bryce, Anthony, you know what? I'm new as the CEO here. Judge me when we get into Q3. We start seeing some of the results, the fruits of our labor really come into fruition here. So you've mentioned some of those updates, but Hut 8 Corp realistically looks like a completely different company than just a few quarters ago. So talk to us a little bit about that transition. How are people feeling? Sue, I know last time you said the excitement, the energy was just contagious in your meetings. Are you still finding that, Asher?
Yeah, Sue, why don't you start on this one since you can kind of talk about the transition and I'll chime in after.
Yeah, so for those of you in your audience who don't know, I've been with Hut since December 2020. We've obviously went through a CEO transition on February 7th of this year. I think if you look at sort of where the business is now, just to sort of drill down a little bit into what Asher was talking about in terms of the 12% margin improvement. So last year, this year, we were able to improve our self-mining margins from 34% to 46%. That's in spite of the halving, and our cost per coin only went up 7%. That is also on the back of having an efficiency fleet of 31.7 joules per terahash. Not a great efficiency, but Asher signaled on our earnings call that we are ready for that fleet upgrade that everyone has wanted us to do for a long time, but Asher was like, no, I'm waiting until the right time to do it. So that's been interesting. I think, as of Friday, we also saw our institutional base uptick to about 45%. So that's up from about 12% at the beginning of this year. And again, that's on the back of really having an operations focused CEO who's driving down costs, increasing efficiency, and also really effectively turning this company into a power and infrastructure company. Because at the end of the day, that really is what HUT is. And so we can certainly get into that, but yeah, it's been a really, really exciting evolution, and I'm pretty excited for the future.
That's and we're awesome. Getting a lot of look, we're only as good as our team, and our team is really excited, motivated. We're having a lot of really interesting people interested in the company and wanting to join. We just announced a new CFO as well, who came from 14 years in the power and utility markets. He was a managing director at Citi and Power Utilities and had done tens of billions of dollars of deals there. And so we're excited to continue to grow and bolster and keep the momentum and energy going and building next generation technologies.
Yeah, excellent. I mean, going back to what Bryce said about you, Sue, being one of the first in his podcast, if I go back to April 2022, the first time I met some of the senior management teams of the mining companies was in London when I met you at the AIM Summit, and so with a few of the other miners there as well. But that I can go back and recall that meeting there. So yeah, we've known each other the longest from a face-to-face point of view, like. But yeah, I mean, going through the actual quarterly earnings, can you give us some of those highlights from that earnings position? I mean, you talked about the margins, which are, I mean, to hear that cost per, the power cost come down to that level there, it's now pushing you in that bracket with the likes of Cypher and TeraWulf, who've sort of like been highlighting their power for the last few years, but you're quite clearly joining that group of miners.
That's right. So revenue year over year went up 72%. And from a cost structure perspective, obviously we have a pretty decentralized and diversified revenue stream. So cost to mine a Bitcoin in our digital asset business got impacted the most because this is the first quarter post-halving. But as Sue mentioned, we have an older fleet, right? We embrace it. We don't kind of hide behind it. We talk about it. And the fleet efficiency today, as you think through our cost to mine a Bitcoin, our cost to mine a Bitcoin today is around $26,000. If we look at what everyone else has reported, you're in a similar range. But our efficiency at 31.7 joules per terahash is a lot worse than everyone else's. And so to be able to get a similar cost to mine a Bitcoin at a much worse efficiency shows how much room for runway there is. The most advanced generation machines today that Bitmain announces the 12 joule per terahash new machine. And so going from 31.7, you can see upwards of a 50% increase in efficiency. And so your cost to mine a Bitcoin, if you look at the same quarter, instead of 26,000, you would have been 13,000, right? Because you're consuming that same amount of power. And so for us, swapping out the machines, we've always said that we believe that that is the easier part of the business. Actually managing the cost structure, the energy, the operational costs, and making sure that that was really robust. That's what we focused our time on when I took over. And I think that's shown through this last quarter. And as Sue mentioned, we shared in our earnings that we wanted to wait for a step function increase in efficiency. And that's happened. There's been 2 new generations announced from Bitmain, one from MicroBT, and since I took over. And that's what really we were waiting for and we believed was going to happen before investing capital into new generation machines. And last point on that is our cost to mine a Bitcoin, if you look at depreciation and amortization, because we have older machines, most of those machines have heavily been depreciated already. And so that's why we also were very comfortable, even though the margin profile is lower, we're not having to overcome large hurdles in depreciation and amortization. So we felt really comfortable in having a strong gross profit margin on mining, even though we had older machines with the way we operate, the technology stack, and the power management.
Yeah, one thing I found looking at the results was obviously we're going to see this imbalance every quarter now with regards to the Bitcoin price and the FASB rules. But actually, if you look at the sort of like the unrealized loss that you had to put into your accounts, it pretty much matched the actual loss for the period. So, you can say, from a sort of like, if you don't include that particular element to it, which unfortunately is going to, depend on the Bitcoin price, the volatility will change quarter by quarter. I mean, the previous quarter, companies like yourselves and those with a big hodl had really good results in terms of, an unrealized gain. And now we're seeing the reverse of that. But actually it showed that you had strength in your earnings, because that was, I didn't foresee many miners getting close to, to break even. in terms of, when you discount that particular line. I thought there was too much there, but you're rightly saying about the depreciation of your machines. It's not as big as some of the other miners who are having to depreciate the latest machines they put on their books and all that. So it was good to see that you were very close there to that position.
I think also, so the street consensus had us at about 9 million adjusted EBITDA. And if you take out, again, that Bitcoin loss from the FASB rebalance, we came in at about a little north of 14 million adjusted EBITDA. So I think like really the main takeaway is for me is that Asher, when he took the helm on February 7th, he said he was going to do something, and that was specifically clean up this business to set us up for future success, increase efficiencies and reduce costs. And he has done what he said he was going to do. So, yeah.
There's two things I want to highlight as well in the financials. One was it's actually not even reflected in our EBITDA. We had a gain of $17.2 million in our trading strategy around our Bitcoin stack. So you remember how I shared that we would pull money in through selling Bitcoin, which we haven't done, trading around Bitcoin, equity markets, debt markets, and project level financing. We've obviously shown some of our quasi-equity debt with Convert Node Code 2, and then also making $17.2 million that was not reflected in the EBITDA. So that's an addition to what we booked there, because it's not a part of the operating business, right? It's an investment activity. But that was a pretty significant gain, I think, for the quarter as well on that. And then from a gross profit margin, if you look at the revenue of our generation of machines, assuming 4.5 cent hash price, your revenue is around $59 a megawatt hour. When you look at the newest generation machines, I mean, you're upwards of $150, $160 a megawatt hour for the same 4.5 terahash. So instead of 46% gross profit margins, you're over 80% with newer generation machines. And that's really the art of the possible. And that's why we waited to purchase, because before this machine got announced, I mean, the most efficient machines in February when I took over were 18 to 20 joules per terahash.
Absolutely. In terms of the hash price at the moment, we did see it pull back to about 35 just over a week ago. I mean, is that cause for concern with you and the peer miners in North America, or is it a case of, because of that low energy cost, it's still a case that we can keep the machines on, still providing a contribution towards our operating costs?
That's right. So if you look at it at 3.5 cents, even with our older fleet at 31.7 joules per terahash, that's about $46 per megawatt hour. And so you were still profitable because our cost is 31.71, right? And then with the newest generation machines at 3.5 cents, that's $121 a megawatt hour with your cost at $31. So you still have really healthy margins. So ultimately, like, our belief is the reason hash price comes down is you have newer generation machines that come in that are so profitable that you still have a great business that you're running. And that's what happens over time with efficiency increases in technology. So that's what we plan for. We're prepared for it. If Bitcoin runs and hash prices run, we'll be very happy. But we like to think about where we think a normalized world is going, and newer machines work just fine, even with 3 cent hash price.
And with regards to your other, so that self-man, with regards to like hosting businesses and managed services, how does the sort of like the hash price affect those type of services? Are you still making? I mean, it sounds like you still make a good margin out of those businesses as well.
That's the beauty. So managed services, we built that business line item because it's pretty stable, fixed revenue. So our margin profile was in the mid 60s for our managed services business. We have the HPC business as well that has a little under 300 customers that have nothing to do with crypto. Then we have kind of other hosting and equipment sales. And so those are not directly correlated with hash price. There's one hosting agreement that we have that's more of a profit share, so that gets impacted a bit on hash price. But overall, the idea behind a diversified business is in time where margins compress, we have more fiat-based revenue streams that offset our fixed costs. And then when margins expand, our net bottom line just continue to increase, right? And so that's really how we like to think about the businesses. We're in a volatile sector. I think no one can deny that. And how do you manage through that volatility? And the diversified approach, I think, has been our way to do so. And recently in the markets, you're hearing a lot more about AI since February when I took over. And so I think you'll see more of that being a theme across others in terms of their businesses.
Just as an add-on to that, I mean, both, if you look at your previous organizations, USBTC and Hut8, both of you benefited from sort of like effectively companies that had distressed assets, went bankrupt. Where do you see the landscape at the moment? I mean, it's great for you guys. You're making a good margin, and if you bring the more efficient miners in, making a great margin. What about everybody else? So, do you think I mean, with that hash price as low as it is, and it reached an all-time low, like say 10 days ago, are you starting to see any reoccurrences of what you saw previously in terms of companies going through a difficult period?
I think the real challenge will be people's access to capital to be able to buy newer generation machines and grow. Because if their margins aren't great, they don't have scale, access to capital is going to be difficult. I mean, that was our belief back in 2022, which is what prompted the merger discussions between us and Hut8 from the US Bitcoin side at the time. And I think that's played out today. We're having a multitude of conversations on greenfield M&A activities and so forth. And so scale matters, and the ability to show investors that you can drive a good return on every investment that you make matters. And the market's going to hold companies to be more accountable on how efficient are they as operating companies, how strong are their costs, and ultimately what return can they make on the capex that invest due to the scale of the magnitude of capex in our industry.
Hey, Asher, I appreciate the details on the fleet upgrade. That's obviously a real exciting point for the retail community. I'm not sure if you've disclosed this yet or not, but in terms of the timeline for this, are you looking at a specific date with one big order? Or are you going to do kind of a tiered upgrade over time, and financing for this? Where will that be coming from?
We'll share timing in the near future. What we've shared publicly is that by end of next year, we want to be one of the leading Bitcoin mining businesses out there. We see Bitcoin mining equally as important as our AI business because it provides a different use case. Bitcoin mining is a cheap way in order to capture megawatts and consume the megawatts today and drive a return on those, while we wait for other use cases that come that may provide a higher yield, like an AI data center. And so it allows us to expand our power footprint, meanwhile keeping that optionality open for infrastructure like AI and high density infrastructure. So I think the announcement, primarily, you hit the nail on the head. There's three things we think about when it comes to a fleet upgrade. Is the timing right, which is what we've been waiting for a long time on. And I think this new step function and efficiency increases is a good market entry and timing before there's some time before something like of this significance comes again. The second is being really thoughtful about how we finance the order. I think we're hoping to kind of share with the market how we think about that when we announce it, because currently it's prepay for the machines up front, you pay on a payment plan before they arrive, and then you have them plugged in and you wait for a return. And so I think we'll have some innovation on there. And then the last thing is the technology and the innovation and the technical stack. And so we'll share across those three verticals, hopefully in short order, as we finish our discussions.
And hopefully on the podcast here, the Power Mining Analysis podcast. Now, hey, you've already talked about industry-leading power costs, which are incredible. You've already talked about combining this business, putting it together, really finding these synergies, these opportunities, having that efficient fleet, and now you say one of the most efficient fleets next year. Another thing you guys really have going for you is this energy pipeline. So we wanted to shift gears a little bit, talk about what this energy pipeline means to Hut8 Corp and how you're really allocating those megawatts. What type of discussions, decisions are going on internally?
Today, we have a little over 1.3 gigawatts of assets that we have under ownership and management today. And we have a gigawatt of net new infrastructure in our development pipeline that we've shared. And that's including us converting out the 205 megawatts. So that's a part of our own. And we've actually backfilled and added another facility to keep that gigawatt as our number. So we have a pretty robust pipeline. What exclusivity means is these are assets that the other side, the generator or the owner, has decided to go just with us as the counterparty that they're talking to about these projects. So no one else is working with them on these projects. So that's why that's the number we share publicly, as we've gone through a lot of the initial diligences and phases and approvals. And so for us, both in terms of scaling Bitcoin mining, but also in terms of scaling our AI and data center footprint, we think the power footprint is what gives us a really key competitive advantage and moat in what we have existing, which is pretty large in terms of scale, and also what's new. So when we talk to different potential AI DLC customers, they're looking at our existing footprint and which one of our sites can we convert over and use that power footprint for building a data center. But they're also looking at new sites that are in our pipeline that are greenfield sites that will be an equal amount of time to energization, because like the one that we just announced at 205 megawatts, the substation is already there. The power approvals are already there, not just from the wind farm, but from ERCOT. So that site building at is the same speed as building at one of our existing projects. And so I think in the discussions we're having, we're pulling out a couple of our projects that we think are really interesting, that have the right tower, fiber connectivity, land, water, and so forth, and having pretty deep discussions on what are the right assets to put in when.
It sounds very optimistic. And also, I mean, we've been fortunate, Bryce, myself, we've been down to some of the facilities in Texas. We went to the Nashville conference, met some of the Wall Street guys there, and heard from them that the focus at the moment, the conversation at the moment, isn't around Bitcoin mining. It's all about HPC. Can you confirm, sort of like from yourselves as a company, with the access to that power pipeline, that, you know, generally the most of the conversation with you guys from Wall Street is about, you know, when you're going to let us know more about the HPC side of things, and if you are going down that route, I mean, you know, the news story of the year so far has got to be the Core Scientific deal with CoreWeave. I mean, nothing can sort of really top that at the moment. Is that a strategy that appeals to you guys in terms of you've got the facilities, you've got the power, you've got the land, you've got the power, and you don't have to worry too much about GPUs or even deals with the power company, that, you know, these big hyperscalers do that for you?
I think that's right. Today, a lot of Wall Street is asking about AI. What is the facilities opportunity to build AI data centers? I think for us, it's important to focus on, and this is what I've done since day one, is not just what Wall Street is focusing on the moment in time, but what are the important criteria of building this business for the long term. And so that's why I said we're not giving up on Bitcoin mining. And from day one, when I talked about AI, I said I'm putting the gas on both pedals. And to give you a little perspective, so the 205 megawatt site that we just announced in the Panhandle, to build a Bitcoin mining site there, assuming call it $300,000 a megawatt, depending on what type of infrastructure you build, you're looking at roughly a $60 million project from a data center perspective. If you look at an AI build for that similar megawatts, you're talking $8 to $10 million a megawatt, which is roughly $1.6 to $2 billion to build a data center. And then when you go next step into compute, the ASICs will cost you roughly, call it $300 to $350 million based on the newest generation machines. And then on the GPU side, you're talking $6 to $7 billion of GPUs. And so the magnitude of dollars is so much larger. When we look at a gigawatt plus what we haven't announced in our pipeline, I think we see both of those as really important growth pillars, because the amount of capital required to get AI data centers, if tomorrow corporate development converted 100% of them, we're talking tens of billions of dollars in converting all of that in the ultimate customer GPUs. And so that's why we think the partnership between Bitcoin mining data centers and AI data centers is really synergistic, especially as we think about our vision, which is increase our overall power footprint. That's the main thesis, in which business segment that we have that drives the best yield, that will ebb and flow through time and through demands in the market, and that cyclicality. And so I think the best way to think about it is we think about the business in 3 layers. Layer 1 is power infrastructure. So that's the interconnect to the grid, the land, the substation. Layer 2 is the data center infrastructure. Whether that be a data center for Bitcoin mining or a data center for AI, we bring customers into that data center and we have a co-location business. And then layer 3 is the compute. It's the actual chips going into the data centers, whether that be ASICs or GPUs. And the reason we segmented in those 3 layers rather than Bitcoin mining versus AI is because we think there's a lot of commonalities between those investment decisions. Obviously, a little bit of difference in terms of counterparty risk, industry mix, and volatility. But power is the least risky of the assets because substations and transformers, you have a really long depreciation cycle on that equipment. And land, obviously, you can have a 30-year mortgage on a piece of land and so forth. When you get to the data center side, you're really looking at that data center at least lasting for 10, 15 years, of transformers, switch gears, building steel. And then when you get to the compute side, whether it be ASICs or GPUs, you're underwriting that within single-digit years, right? And you're really thinking about what is the efficiency decay relative to the return profile we get. And so that's why we segmented in those three buckets. And you'll see how we think about financing as well, because I think there's different investors for all three, with compute being the highest cost of capital and just like land being the cheapest cost of capital. And you'll see how we think about that project level financing as we continue to be able to give investors the exposure that they want, rather than us have a really high blended average rate.
Yeah, it's a good point you've mentioned, and all valid. And also the fact that I suppose with HPC, because of the predictability of revenues and costs and therefore margins, it opens up another sort of like potential for borrowing in the future against that type of business, rather than sort of like the volatility that we've seen in the last, well, certainly my time in the 4 years in my space in this industry, the volatility of Bitcoin price. Well, we can't predict tomorrow's price, never mind today or next year. So that's a challenge. But yeah, thanks for that update.
Hey, I want to get into HODL and institutional interest, because I know you guys have had a ton of meetings and discussions with a lot of these institutional level clients. Before we do though, Asher, I wanted to just pick your brain a little bit about the Ionic situation. We've been hearing different pieces of news come up on X and Twitter. I wanted to get directly from you guys if you're able to share anything there.
Happy to do so. I think I'll share high level because we're under confidentiality in our kind of managed services agreement with Ionic. So I can't go into too much depth. Otherwise, we would have been more responsive on social media and so forth. But when we started the process and getting involved in the Celsius bankruptcy process, really the thesis was there's a lot of assets here. 4 Bitcoin mining facilities at the time, which were 80 or so megawatts. And then you had a lot of machines, about 12 exahash machines, which were in boxes primarily, right? And we said liquidating these assets will drive less return to the creditors than actually turning this into a growing concern in a business and getting these commercialized. During the bankruptcy, I actually helped with Celsius and Core Scientific coming to a deal for the Cedarville site, which is the core kind of site of Ionic today, which is 200 to 240 megawatts on that facility. And so overall, when you look at the business today, it's about 300 megawatts of data centers, about 12 exahash. And we've worked throughout this year to get that Cedarville built out. So we brought on the first 40 megawatts. We had the buildings being energized now as well. And so the process of actually executing the business itself is well underway. And I think the thesis, the company today is more valuable than it was last year, because now you have facilities that are built and you have machines that are plugged in, and that's way more valuable than just pieces separated out in warehouses. I think like any business, however, when you're starting it up, especially starting it up at this scale where there wasn't a team there, and there's a new board of directors, et cetera, there's growing pains, right? There's growing pains from, does the management team sync with the board? And I think ultimately with Matt and his disconnect, I think the board wanted someone who had no connection with HUD and would keep us honest. And I think that's fair. And so we've been supportive. I stepped off of the board as well because they wanted folks that we had in our seats to not have any association with HUD as well. And so we've been respectful of those wishes. And then finally, I think there's some noise around like the restructuring of the agreement. So Ionic had come to us and asked to restructure the agreement, and we had a discussion about what is the best way to restructure now that we're out of bankruptcy in a status quo, where we make sure we align all the incentives that the agreement drives, and as we've learned through how the agreement operates over the last year. So I think one of the main updates was the managed service fee originally was kind of a $20 million all-in buffet style model where we would operate sites for them. And they said, look, right now we're focused on getting these sites online, giving liquidity to our shareholders who are the creditors of Celsius. Can we drop the fee from 20 to 15 million? And then as we bring on more sites, we can do a more variable approach where you get paid on more sites that we bring in, but that way we save that cost today before building kind of the next site. So I think we agree because that aligns incentives where as they grow, we are aligned to want that to grow because we get economically incentivized, but today they have a lower rate and a lower burn on the business. And so I think that's kind of the first thing. And then in terms of the liquidity deadline and the threshold, I mean, there was a date that had passed already. And really what we gave them too was an ability to have different mechanisms where they weren't in this agreement for the whole duration. And there was some rights that they had in order to help the business have flexibility as they grow and evolve. And so really the goal from both sides has always been like, how do we make sure that the idea that we had last year actually plays in? And I think the execution of the sites speak from themselves and these sites getting energized. And the company is just going through a little bit of kind of changes in finding the right management team, the right board of directors with the right auditors and things of that nature. And I think we were a lot more involved earlier on, but their wishes were Hut 8 also has its own mining and they wanted us to have a certain point of separation, but be supportive as they ask for strategies and advice. And so we're supporting them through our agreement and any other asset they have.
I think just to put a cherry on what Asher said, one of the hardest things when you have a transition period like this is that oftentimes key players whose hearts and minds and everything was in the right place often get, thrown under the bus. So I think, I just want to come out and say that Matt Kusac is truly one of the kindest, best intentioned, brilliant people we know. And I really, really hope that the market gets another chance to get to know him. Because right now, I think he's been somewhat exiled and everyone's pointing the finger at Matt and blaming Matt. But honestly, he is a very, very good person. And I will come out and stake my career on that. So anyways, I just hope that the market has an opportunity to get to know him better because he's a 12 out of 10. And I think that retail institutions would absolutely love him. So anyways, that's just to put a bow on what Asher said.
I fully back that statement. Yeah.
Yeah, thanks. So obviously one of the things that we always prided Hut 8 having was probably one of the strongest balance sheets of all the mining companies, and that stacks up in the fact that you've still got over 9,100 Bitcoin on the balance sheet of the new company. What's the plans for that? I mean, you indicated in previous podcasts that you would spend it when the appropriate time came, or sell some of the Bitcoin. What's the feeling over sort of next 6 to 12 months with regards to getting capital in to grow certain aspects of each of your businesses?
And I think maintaining a strong balance sheet, meanwhile being equity and dilution sensitive as well, right? We brought on $150 million from Code 2. I think in a really novel structure. Today, everyone's doing converts now, but it was really kind of earlier at the time. But the idea was they were interested. We said we didn't want to raise equity at these levels, and raising at a 50% premium to where our stock was trading was, and that was a lot more beneficial than raising kind of at fair market value. So I think our perspective has not changed. Everything on our balance sheet is working capital to invest in growth opportunities. And what we think about is what is the cost of capital within the 5 pillars, which is our balance sheet, yield off of our balance sheet, like we did with the derivative strategies this last quarter, equity markets, debt markets, and project level financing. You'll see a lot more of us talking about project level financing that we're doing as well on a go forward, because that's a great way of equity and debt that's not dilutive to the parent company and protects against risk and gives investors pure exposure as well. And so I think we're not one-minded, one set a framework. Our thought is based on market dynamics, our job is to drive return to our shareholders and to invest in the right projects. And building out, for example, a Bitcoin mining facility and machines is a levered proxy to Bitcoin itself. The machines will be more valuable if Bitcoin prices go up, and the yield they generate will be more valuable as well. And so for us, I think we'll constantly monitor the equity, debt markets, project level financing in the balance sheet, and use the cheapest source of capital we had at any moment in time relative to the investment opportunities that we have at that time.
Just a quick aside to that, we've seen one of your peer miners go out there and buy a significant amount of Bitcoin. Is that a strategy that Hut 8 Corp would ever be interested in doing?
I think we haven't shared any of those ambitions today, but I think today we are spending a lot of time thinking about, we have a diverse business, right? And when we think about diverse, not Bitcoin mining and AI, but power, data centers, and compute. And those are three different types of businesses. And compute, I actually split into ASIC compute and GPU compute. And so we're thinking a lot about, where does our capital go? How do we finance the business? Who are our shareholders? What do they want from us? And I think you'll see us talk a lot more about that in the coming quarters, and how we believe we can realize the best amount of value for what we're building here.
Hey, Sue, I know you guys have been extremely busy. Even since Nashville, we were trying to find time for a lunch, and you've been just packed with meetings. I know a lot of them are institutional focused. You guys are really attracting a lot of attention from Wall Street and the big banks. Can you talk to us quickly? I know we only have a couple minutes left, just about how this process has gone, the type of calls you're receiving, level of institutional ownership versus kind of at the old Hut 8. How are things progressing on that front?
Yeah, so our institutional footprint has gone up from about 12% at the beginning of this year to now 45% as at Friday, which has been really exciting. I think what's been the most fun part in my chair is the level of new investors. So obviously on the institutional side, we're talking TMT investors, global small cap tech investors, not so much crypto investors, power investors. We hosted a buy side breakfast in Nashville, and there was a couple of very meaningful or sizable power and funds that came to that breakfast. And you know, a lot of these managers are pretty candid. They're like, listen, I'm not really here to talk about exahash, not really here to talk about Bitcoin. I'm here to talk about how I think this is a power and infrastructure company. Or there's another group of institutional investors that are like, we think this could potentially be an emerging data center REIT trading at a tremendous discount. So for example, Bitcoin miners, I think, trade at about 4 million per megawatt versus a data center REIT can trade at about 32 million bucks per megawatt. So that's a significant discount. So those are the two sort of different camps of institutions who are those are the two different theses that some of these new institutions are running with. But again, I think obviously also having a partner like Coatue has certainly helped. They're known as being very founder friendly, and also it's kind of like, you know, they've got a lot of friends in the buy side world as well that are like, oh, wait a minute, if you know Rob and Philippe are looking at you guys, maybe I should take a look too. So it's been really fun. I don't think I said exahash at one point for like 6 weeks, which was crazy, having been in this industry.
And it's funny, right? Because when I am in those conversations with Sue, they're like, okay, so you're not doing mining anymore. I'm like, no, on the contrary. I think it's like the way that I phrase it is, mining is our way to power bank. We bank our assets with mining, and we lock them in, and we drive yield on those. And I think when you share that mindset and how you think about mining as a tool to lock in megawatts, people go, oh, that's really interesting. And especially when you tell them the economics of how much it costs to build a Bitcoin mine versus an AI data center, they even more realize, okay, this is a way for you to really cheaply be able to just lock up as many megawatts as you can and not have to wait on a customer contract, but be able to just control your own destiny and build out that scale and lock in power purchase agreements as they become executable.
Exactly. The current and future value of electrons we capture using Bitcoin mining, and we're going to continue to do that. Because also, and Asher said this before too, not every site is going to be AI eligible, right? Like, so that's why we're driving hard at both. But yeah, it's been a lot of fun.
Yeah, it's really interesting to see it. I'm happy to hear these institutions are coming around. And I think once Bitcoin cracks 100 or 150, they'll start to have a little more interest in it. But you're totally right, Asher. It's a great little complementary component, almost a pressure let off for the system, or whatever kind of analogy you want to draw there. But you guys, I know you're busy. I know you've got a lot going on. Phenomenal numbers. Asher, really excited to see this journey from the ground up, watch the transition of this organization and the leadership team under your vision there. You're doing a great job. I'll throw it back to you guys for any closing thoughts. We appreciate the time, the comments, and the insight as always.
Really appreciate the opportunity to be on these calls with you all, and future ones, whatever questions you guys have, excited to dive deep into them here. So thanks again, everybody, and stay tuned for our journey.
Yeah, you bet. Thanks so much, guys.
Sounds good. If you're still watching, you guys, like, subscribe to the channel. If you have questions, leave them below. We'll see you here tomorrow.